A dividend is a payout from the company to its shareholders from its net profits. The shareholders are entitled to dividends as the owners of equity in the business. A franking credit is a tax credit paid by some companies which lowers the tax payable by the shareholder receiving the dividend. So why are franking credits so important? So under the classical tax system, like in the US, dividends are taxed twice. Once at the company level, that is, the company pays tax before it's receiving its net profits, and then once again at the personal income tax level by the shareholder receiving the dividend. Let's contrast that with the imputation system. So under the imputation tax system, like Australia, where franking credits are available as a tax offset, the net effect is that shareholders only pay tax once on their dividends at their personal income tax level. That is, the franking credit offsets any tax paid by the company at the company level. Therefore, as a result of this, dividends are more attractive in countries operating under an imputation tax system like Australia, as compared to countries operating under a classical tax system like the US. Let's look at an example for someone at the highest tax bracket. Under the classical tax system, tax is paid twice on dividends. Once at the company level, once at the investor personal level. So at the company level, we have a taxable income of $100. They pay 30% company tax on that, resulting in a net profit of $70. Assuming that entire $70 is paid out as a dividend, the investor receives $70. There are no franking credits under the classical system. Assuming they're at the top tax bracket, that is, in Australia, they're paying 45% on their tax, that means that they're going to be paying $31.50 in income tax on the $70 dividend. Therefore, the net amount received is the dividend less the income tax, which results in a net amount of $38.50. Let's contrast that with the imputation system. So at the company level, the exact same thing happens in terms of there is $100 taxable income, they pay $30 company tax, leaving a net profit of $70. Assuming again they pay that entire $70 out as a dividend to the investor, then what happens is we add back a franking credit of $30. This $30 represents the company tax that was paid at the company level. So now the investor has received $100 and now they have to pay the income tax on that $100. So 100 multiplied by the maximum income tax rate in Australia of 45% results in income tax of $45. So the net amount received is going to be $55. Therefore, we can see that under the imputation system, dividends are more attractive than under the classical system because investors will receive a higher amount. Here in our example, the investor would receive $55 from their dividends after tax, as opposed to $38.50 from their dividends after tax. Now as well, we can talk more about dividends when it comes to dividend signals and growth signals, but we'll talk about that more in another video. Thanks for watching.